There is one decision in personal finance that costs more money when you get it wrong than almost any other. It is not which ETF to buy. It is not when to buy a house. It is the question that comes up the day you open your first retirement account and never gets revisited. Roth IRA or traditional IRA? On a $7,500 annual contribution over 30 years, choosing the wrong one for your specific situation can cost you between $180,000 and $340,000 in retirement income. Most people get the framework completely backwards. Most financial advice on YouTube tells you to pick the Roth every time, no matter what. That is wrong. The right answer depends on you. Today, I am going to give you the only framework that actually answers this question correctly, verified from the IRS, current 2026 tax brackets, and the real math behind both accounts. 3 things: what the two accounts actually do and where they fundamentally differ, not the marketing version, the IRS version. The real 2026 numbers behind both: contribution limits, income limits, tax savings, so you can see exactly what each one is worth in your situation. And the decision framework that gives you the right answer based on 3 specific factors about you: your current tax bracket, your expected retirement tax bracket, and your age right now. The traditional IRA and the Roth IRA both let you invest $7,500 per year in 2026, $8,600 if you are 50 or older. Both grow tax-free while the money is inside the account. Both let you invest in stocks, ETFs, bonds, or mutual funds. That is where the similarities end. The difference is when you pay the tax. Traditional IRA, you contribute pre-tax money. The contribution reduces your taxable income today. You pay 0 tax on the money going in. You pay full ordinary income tax on every dollar coming out in retirement. Roth IRA, you contribute after-tax money. No deduction today. You already pay tax on these dollars. But every dollar coming out in retirement, including all the growth, is completely tax-free. That single difference, when you pay the tax, is what determines which account wins for you, and it is not the same answer for everyone. The traditional IRA's strength is immediate tax savings. At the 22% federal bracket, contributing $7,500 saves you $1,650 in federal taxes this year. At the 24% bracket, $1,800. At the 32% bracket, $2,400. That is real money. Money you can invest, use to pay down debt, or fund another retirement account. The math is most powerful for high earners in their peak years, where every dollar of deduction comes off the top of the highest bracket. The weakness is the cost on the back end. Every dollar you withdraw in retirement, including 30 years of growth, is taxed as ordinary income. Required minimum distributions start at 73, meaning the IRS forces you to take money out and pay tax on it, whether you want to or not. And the wild card? Nobody knows what tax rates will be 30 years from now. The traditional IRA bets that your retirement tax rate will be lower than your current rate. If it is, you win. If it is not, you lose. The Roth IRA's strength is certainty. You pay the tax at a rate you know, today's rate, and you never pay tax on that money again, period. No matter how much it grows, no matter what tax rates do in 30 years, no matter what bracket you are in when you retire, every dollar is yours. The other strengths nobody mentions enough: no required minimum distributions ever. Tax-free withdrawals do not trigger Social Security taxation. They do not push you into a higher Medicare premium tier. They give you a tax-free lever to pull in any retirement year you need flexibility. The weakness is the cost on the front end. You pay full tax on the contribution. At the 24% bracket, $7,500 contributed actually cost you $9,868 in pre-tax income. That money is gone. You cannot deduct it. And there are income limits. In 2026, if you earn over $165,000 as a single filer or $246,000 married filing jointly, you cannot contribute to a Roth IRA directly. That is when the backdoor Roth strategy becomes essential, and we have a full video on that in the description. Here's the math that makes this decision concrete. Person A and Person B both contribute $7,500 per year for 30 years. Both earn 8% returns. Both end up with the same gross balance, approximately $850,000. Person A used the traditional IRA. In the 22% retirement tax bracket, withdrawing $850,000 over retirement triggers approximately $187,000 in total federal tax. Net to Person A, $663,000. Person B used the Roth IRA. Tax already paid. Net to Person B, the full $850,000. The difference, $187,000 from one decision made 30 years earlier. But here's the twist. Most videos skip. Person A also had $1,650 per year in tax savings from contributions, $49,500 over 30 years. If Person A invested every dollar of those tax savings, that money compounded to approximately $186,000 at 8% returns. Person A's true net, $663,000 plus $186,000, equals $849,000, almost identical to Person B's $850,000. The Roth versus traditional debate is a wash if and only if the tax rates are identical and the tax savings get invested. The moment those two conditions break, one account wins decisively. 3 questions, honest answers. The right account follows. Question 1. What tax bracket are you in right now? If you are in the 10% or 12% bracket, Roth wins. The tax cost is so low that paying it now is almost free. If you are in the 32% or higher bracket, traditional wins. The tax savings are too valuable to give up. Between 22% and 24%, the middle bracket, it depends on the next 2 questions. Question 2. What tax bracket will you be in retirement? If you expect to be in a lower bracket in retirement, traditional wins. If you expect to be in a higher bracket in retirement, Roth wins. If you expect them to be roughly equal, the next question breaks the tie. Question 3. How confident are you in predicting future tax rates? The federal debt has tripled since 2008. Social Security depletion is at 2032. Most economists expect tax rates to rise, not fall, over the next 30 years. If you have any belief that taxes will be higher in your retirement years, Roth wins. The Roth IRA pays for the certainty of locking in today's rate forever. The verdict by profile. 3 profiles, 3 different correct answers. Profile 1. You are 25 to 35 years old. You are early in your career. You are in the 12% or 22% tax bracket today. Roth IRA. Always. Your current tax rate is almost certainly lower than your peak earning years and lower than expected future tax rates. Pay the small tax now. Lock in 40 years of tax-free growth. Profile 2. You are 35 to 50 years old. You are in your peak earning years. You are in the 24% to 32% bracket. Split it. Contribute to both. Use the traditional 401k at work for the immediate tax savings on a high income. Use the Roth IRA for tax diversification in retirement. You get the upfront deduction and a tax-free bucket to pull from later. This is the optimal strategy for the largest segment of working Americans. Profile 3. You are 50 to 65 years old. You are in your highest earning years. You are in the 32% or 35% bracket and have access to a 401k catch-up contribution. Lean traditional for new contributions. The tax savings at those brackets are too valuable to surrender, but if you already have substantial traditional IRA money, consider Roth conversions during low-income years between retirement and Social Security claiming. That is the Roth conversion ladder we covered in another video, linked in the description. 3 things changed the Roth versus traditional math in 2026 specifically. 1. Social Security depletion moved to 2032. Future benefits are projected to be cut by up to 28%. Tax-free Roth withdrawals do not interact with Social Security taxation, making the Roth more valuable as Social Security becomes less reliable. 2. Federal debt continues to grow. Most credible economic forecasts project tax rates will rise, not fall, in the coming decades. That tilts the equation toward Roth for nearly every age group. 3. The One Big Beautiful Bill signed in 2025 left both account types untouched. The Roth IRA and traditional IRA are stable, permanent vehicles. The current 2026 contribution limits and rules are reliable to plan around for the foreseeable future. This is the right year to make the decision and execute it. The Roth versus traditional question has been around for 28 years. Most people answer it wrong because they listen to a single piece of advice instead of running their own 3-question framework. Your tax bracket today, your expected bracket in retirement, your confidence in future tax rates. That is the framework. The right answer for a 28-year-old in the 12% bracket is the wrong answer for a 55-year-old in the 32% bracket. There is no universal right answer. There is only the right answer for your specific situation. Open one of these accounts at Fidelity today. Link is in the description. Takes 8 minutes. Whichever you choose, funding it consistently for 30 years matters more than which one you chose. The difference between the right account funded and the wrong account funded is $187,000. The difference between either account funded and no account funded is the entire retirement. Drop your pick in the comments. Roth if you are choosing tax-free retirement income. Traditional if you are choosing the deduction today. Split if you are doing both. I read every single comment, and I am always genuinely curious where this community lands on the most consequential retirement decision in the tax code. If this video gave you the framework you needed, hit like. It helps the algorithm find someone else who is about to make the same decision. Next Tuesday, the math behind buying versus renting in 2026. With mortgage rates at 6.7% and median home prices at $417,700, the math has changed dramatically, and almost no one is calculating it correctly with current numbers. Subscribe and keep drawing your way to wealth.